Thank you. Sorry, I always feel like I need a pedal still to be standing on behind the lectures. Apologies. Inga iwi, inga mana, inga hoa mahi, tēnā koutou katoa. E mihi ana, kia koutou, kua tae mai ki te tautoko, tēnei kaupapa. Nā mihi nui kia Luiz de Mello, te kaipōrero o whira. Tēnā koe. Ko Kieran Fowley, toku ingoa, no mai, haere mai ki te tai ohanga. So welcome everybody. Thanks for joining us on this not so nice Wellington day. I know we've got a number of people online as well. I'm Kieran Fowley. I'm the Assistant Secretary of Economic Strategy at the New Zealand Treasury. And it's really wonderful to see you all here today. And a very warm welcome to our presenter, Luiz de Mello, as well. Just before we kick off, I just need to go through a few hygiene matters. In the event of a fire alarm, please follow Treasury staff to the nearest exit and progress down the stairwell to evacuate the building. Don't use the lifts. In the event of an earthquake, please practice your turtles, drop, cover and hold, stay in the building and don't leave until instructed by a warden. And finally, bathrooms can be found to the left-hand side of the kitchenette, which is walk to your right after exiting this room. So our theme for the Treasury Guest Lecture Series this year is Navigating Global Shifts, Resilience, Challenges and Opportunities for New Zealand. And as we've heard multiple times over the last few weeks, in hindsight, choosing this theme couldn't have been more timely. For New Zealand, as a small and open economy, adapting to global shifts, reshaping trade patterns and capital flows is essential. And learning from international organisations that look across countries for best practice is really essential for helping us to navigate these shifts. And one of the reasons why we really, really value our relationship with the OECD. The OECD analysis provides us an opportunity to look up and out on New Zealand policy, something that is more important now than ever. New Zealand's policy settings have delivered macro stability and credibility, but the series of recent global shocks have underlined the need to look harder at our micro resilience, especially across areas like energy, trade and supply chains. And using examples such as our reliance on imported liquid fuels, Luiz will explore how micro-level vulnerabilities can amplify shocks and outline how industrial policy focused on fixing coordination failures, lifting technology diffusion and strengthening economic ecosystems can lift productivity and resilience. In doing so, he will draw from the OECD's vast experience with cross-country analysis to identify policy options for New Zealand to consider to lift our economic performance and enable us to better adapt under stress. Now, just a few details on Luiz himself. Luiz is the Director of the OECD Economic Department's Country Studies Branch. He's in New Zealand to launch the 2026 Economic Survey of New Zealand, which we did yesterday very successfully. And I encourage everybody to take a look at the survey. There's a lot of really great detail. And if you're a policy wonk, you'll love it as well too. So please do take a look at that. He leads the country studies team, overseeing analysis and policy advice on structural policy, macroeconomic outlooks, public finances, and broader macro issues to support stronger, cleaner, and more inclusive growth. Previously, he held senior OECD roles, worked at the IMF, and lectured at the University of Kent. He holds a PhD in economics from the University of Kent. We do have a long-standing relationship with Luiz and with David also from the New Zealand desk at the OECD. And so we thank you both for continuing to be very generous with your time and ideas to support New Zealand. So just in terms of the structure of today, Luiz will speak for no more than 45 minutes. We'll follow the presentation with a discussion. We'll welcome questions from both within the room, but also from our online audience. For those of you who are online, there is a Q&A function in Teams. Please post your questions there. And if there are any technical difficulties or technical queries online, please use the usual chat function. And in the Q&A, if you're online, please feel free to vote on the questions you like with a thumbs up, and we'll make sure to cover those popular ones first. Thank you again, ngā mihi, and over to you, Luiz. Welcome.
Well, thank you very much, Karen. Your introduction was very kind, and I'll try to, make sure that I don't speak for more than half an hour. It would be nice to hear from you all your thoughts about the topic, and I don't want to overstay my welcome in terms of your attention span. So I'll try to be brief. And congrats to the Treasury on picking the topic of resilience in your series. That's really an issue that is coming to the fore for obvious reasons in our discussion with OECD countries. And then what I'll try to do here is to share some thoughts that are emerging from those discussions and try to apply them to the extent that we find useful to the case of New Zealand. I mean, obviously, you know New Zealand infinitely better than me, but I hope that some of the international discussions and experience can add a bit to your own policy discussions in this area. I thought I would start with a rather simple point based on New Zealand's performance over the last quarter of a century or so. And my message here is that essentially you've performed reasonably well over this time. So no, don't beat yourself up. It's a comparatively strong reading that you can see in terms of on the chart of GDP per capita growth compared to other advanced small economies, which are probably your most natural benchmarks in the OECD area. You're doing well. If you compare your performance to the OECD average as a whole, you are just about the OECD average in terms of GDP per capita level. In terms of growth, you've been tracking more or less the average of OECD countries over these 2.5 decades. Where you stand out a bit could be in terms of the volatility of this growth. And then you see on the right, this is obviously a very crude measure of volatility, just the coefficient of variation over the trajectory of growth that you've had. And then you see that relative to other economies, you have had a history of growth that has been a bit more volatile. So what does it mean in practice is that, performance has been good, but, you've had a fair number of shocks that have made growth volatile as well. And in a world that is becoming more volatile, given, all the issues that we know about, and we don't need to go into in great detail, you're already starting from a position of some volatility there as well. So if you look, let me try this. Yes. If you look at the issue of volatility, I think it's nice to start off by looking at an indicator, a synthetic indicator, measure of volatility in the World Uncertainty Index. And then you see here from the chart that there seems to be some level shift in the mid 2010s, and even before you got to the points where we are now in the extreme at the far right of the chart, where that amount of measured uncertainty has really spiked and has reached the levels that we haven't seen over a longer period of time. And that includes obviously all the adverse supply shocks that we've had over the last 6 years, the pandemic, the energy price spike following the onset of war in Ukraine in 22-23, but then more recently the conflict in the Middle East that is still unfolding. What it means more at the micro level is that, over this period of relative calm, supply chains have changed qualitatively. They have become more complex, they have become longer in many cases, and that has exposed this at the micro level, the way our economies operate, to some stress points. There's some of those choke points, if you want, in the literature jargon, where you have those single points of failure that expose systems to shocks and to then the propagation of those shocks in ways that I'll come back to a bit further down. So to me, that's what motivates the point about resilience. That in addition to efficiency, which is what we've been talking mostly about over the last 2 decades and a half, resilience has gained prominence in the policy debate more recently. So what does resilience mean? I think it's also useful to think of the different aspects of what can be considered resilience from the economic standpoint. And there I would say that essentially, first of all, is that it doesn't mean self-sufficiency, right? So if you could isolate yourself from any possible source of exogenous shock, then obviously you would have, no need to worry about that. But that's a truism. It's not really a way of thinking about the economics of resilience. It's essentially the way we're thinking about it. It's how you prepare for and how you manage shocks that hit you in a way that can minimize short-term disruption and longer-term scarring. Essentially, that's the simple way that you can think about resilience. And there are two basic aspects to that. One is a macro aspect, the one is a micro aspect. What we see typically is that at the macro level, when you have, fiscal buffers in general in your economy, when you have credible monetary policy and institutions that underpin that credibility of monetary policy, when you have robust institutions in general, you tend to be more resilient at the macro level. And you can think of, if you plot indicators at countries that measure these features against, level of volatility, the performance in growth rates, productivity rates, and so on, you tend to find a positive correlation there, which is well known in the economic literature. And then you have a micro aspect to it, which is, I think, as you mentioned, Karen, what is gaining more prominence in the policy debate right now. And it's essentially how your supply is diversified, how you have built-in buffers such as strategic reserves of important inputs that you use in your economy, how much spare capacity you have in sectors that then could accommodate some of the pressures that would emerge when an adverse shock hits you. Some features of value chains, obviously, are more associated with greater resilience than others. So essentially, that's the way, very simple, in very simple terms, how we've been thinking about resilience. So if you agree with this very broad characterization of what resilience might be, then what I would like to do is to essentially look at New Zealand and see how do you perform on the basis of both macro and micro resilience on using some basic features of your economy. And then I would argue that you tick more boxes at the macro level than you do at the micro level. This is not unusual, and this is not essentially a policy failure or something that you've not done right over the years. It's essentially that the world is changing, and that now we are paying more attention to certain aspects of the responsiveness of economies to shocks than in the past. So it's a changing environment that is exposing weaknesses rather than a policy failure per se. So let me start with macro. The macro settings in New Zealand, and try to make the point that this is really a strong source of resilience that you have. You have essentially, in terms of the public finances and fiscal policy, a principles-based management of the public finances, which has worked well, has delivered levels of debt that I will show in the next slide that are comparatively low. You are in a much better position than many OECD countries on that front. And that's a very important element of resilience. You have a credible, stability-oriented monetary policy that is also serving you well in terms of cushioning effects of shocks on the economy in the short term. And you have, an economy that is open to trade, which is, again, one very important element, especially considering your specific features of, being a small economy in a very remote part of the world. So that, I think, is one of the key characteristics that you have that shape or color what you can think of in terms of building resilience. But let me just say a word about the public finances. I mean, if you look at this chart, you see your debt to GDP ratio by comparison with the other OECD countries. You are very well placed in that respect. And why is it good to have public finances that are solid, debt levels that are low, essentially that you can allow your automatic stabilizers when you are hit by a shock to operate freely. What we see in OECD countries is that in countries that have very high debt GDP ratio, the situation is very different. Essentially, in a situation of a negative shock, they may not be able to let the built-in stabilizers operate freely. They have basically to use, active fiscal policy sometimes to override those automatic stabilizers. So you end up in a situation of sometimes pro-cyclical adjustment in downturns, essentially because your high debt levels do not allow you some latitude that you would need to allow the stabilization function of fiscal policy to operate along the business cycle. So keeping levels of debt low as you aim to do. Yesterday, when we launched the survey, we touched on some of these issues, and so preparing for the emerging pressures that you have on the spending side, making sure that you maintain that longer-term sustainability of the public finances is a key ingredient to macro stability and macro resilience, especially again in a small remote economy. You also do well in terms of your institutional settings for essentially, facilitating adjustment in the economy. I like this chart. This is a chart that I borrowed from a publication, a work that colleagues did some 15 years ago. By looking at the institutions in OECD countries that are most conducive to effective risk sharing. So they looked essentially at how your social protection mechanisms work and how a reallocation works in your economy. So the reallocation, and basically we're thinking of product market regulations that are pro-competition, that are pro-entry of firms into sectors, insolvency regimes that are more favorable to the exit also of firms. So employment protection legislation that is flexible, that allows then markets to adjust based on the macro conditions of the at the time that shocks hit. And then we looked at the different typologies of combinations of those institutions. In social protection, we're talking essentially about how your unemployment insurance works and so on. So you can have an idea of what those two axes basically try to depict. And what you see is that there is a wide variety of experiences and situations in the country. You are there, obviously, with the English-speaking countries at the top, where you tend to have, risk-sharing mechanisms in your economy that are, very much based on pro-reallocation or reallocation facilitating, to use the words that my colleagues use in the paper. So, basically, your institutions help with the reallocation, and reallocation is extremely important when you are hit by a shock. How you basically, not only combine capital and labor when economic conditions change, but how you go beyond that and you think about adaptability at the firm level and so on, which is a topic I'm going to come back to in terms of micro resilience. Other parts of the OECD tended to have, a less reallocation friendly regime, but they tend to rely more on other institutions that in a way cushion the shocks and reduce the negative impacts that they may have on businesses and households. So I think that overall, I think at the macro level, this is all macro essentially, not that we are talking about. You have, institutions and the way you conduct policy that essentially, put you in a very good stead to withstand the negative shocks when they hit you. So at the macro level, I think you are doing fairly well. Let me try to take you through a couple of slides, basically to dig a bit deeper into this idea of reallocation-friendly policies and settings, and then how it affects resilience. I mean, if you look at product market regulations, for example, you're very close to the OECD average, which means that your regulations of product markets and services tend to be sufficiently pro reallocation and pro-competition. You are good at parts of this indicator, what is captured by this indicator, in areas, for example, of administrative requirements for business, for the establishment of businesses, for various types of, especially startups, small firms that enter markets. So that you do comparatively well if you look at other OECD countries. You do less well in areas like permitting and licensing, things that are very important when it comes to especially infrastructure development. I'll come back to this point later on. But on average, you are very close to the OECD average in terms of how pro-competition your regulations are. FDI is another area where you are not, as well placed as other countries. You tend to have a regime related to foreign investment that tends to be more restrictive than in other OECD countries. So that basically covers the product market side. If you look at labor markets, this is another indicator that we have in the OECD of flexibility in employment protection legislation. You are well placed, relative to other OECD countries. You've had, good outturns in terms of increases in labor force participation and employment over the years. In fact, that is one of the features of how you've managed to grow over time. Is essentially, you've been able to allocate resources well. You've been able to boost labor supply. You've been able to make sure that increase in labor supply is translated in higher employment as well. You've done less well on the productivity front. That has been where growth in productivity has been comparatively slow over time. But if you look at this slide and the previous one, essentially it's a story of having features of your macroeconomy that are well aligned with what you would expect from an economy that is well prepared and resilient from the macro standpoint. Let me turn then to another aspect that is important for macro resilience, which is insurance mechanisms. You have very nice, nice experience with certain types of insurance. I know, given the features of your economy, exposure to climate-related hazards, earthquakes and other vulnerabilities in terms of natural extreme events. What we are seeing is that, over time, insurance is being stretched. Even if you exclude the peak of the 23, related to the weather events in the North Island, you see a gradual trend increase there in terms of claims in insurance markets. So something to think about. In the 2024 survey, we delved into the top of insurance mechanisms as well, because after all, when you are confronting an adverse shock, insurance mechanism, having good coverage, accessible, deep, liquid insurance markets is an important first line of defense before you start shifting claims on the public finances as a way of acting as the backstop to those developments. But then let me turn to the micro side, which is the area where I think more thinking could be done. If you think of essentially your sources of vulnerabilities, I think there are three main types or three main blocks of vulnerabilities that one can think about. And they are essentially about external dependency on critical imports, external access via transport and connectivity, extremely important given your smallness and remoteness. And the third point that is essentially about internal systems, infrastructure bottlenecks, things that have to do not with the outside world, but how shocks may propagate given your domestic economy. So let me spend the next 3 slides talking about each one of those three blocks. fuels. And again, yesterday for the economic survey, we spent a fair amount of time discussing that, how an economy like yours, with the mix of energy sources that you have, dwindling gas reserves, how it affects the operation of electricity. Markets, in a country that went from a situation where you had very low prices for electricity, so a very competitive environment in terms of electricity prices, and that has shifted over the years. And nowadays you are a country that with among the highest costs of pricing of electricity in the OECD. So this aspect about how electricity, gas, and fuels in general, affect resilience is one that is important to think about. Again, this is not about autarky. It's not about being completely self-sufficient in fuels. First of all, because it cannot happen in practice, especially in a growing economy. It's more about recognizing the systemic risk associated with the type of reliance that you have, and how that can amplify shocks when they hit you. Let me also mention the case of transport connectivity, which is that second block of vulnerability. The issue here is not so much about the existence of supply at the global level, but access that you have, and that, again, smallness and remoteness is something that creates an added layer of vulnerability, because if there is really an issue of a supply constraint at the global level, other bigger economies, more integrated, more geographically closer to big production centers, may be favored in that case. So again, it's not a matter of isolating yourselves from the world. It's a matter of understanding and dealing with the systemic nature of shocks that may occur at that level. And then the issue about the domestic infrastructure, an important source of vulnerability. We are seeing that in many OECD countries where concerns about the changing nature of climate-related hazards and shocks in that area, extreme weather events, the pressure that is putting on basic infrastructure. There is, this is an area where external shocks like weather events and internal systems interact very closely. How vulnerable you are to the loss and damage to basic infrastructure in ways that may, delay your reaction and amplify those internal shocks. In the past, we used to think of infrastructure resilience as something for engineers, that it would be, essentially how you would think about the physical integrity of infrastructure. But now, the nature of the world is changing, so that, beyond engineering, other aspects like a core microeconomic implications for resilience come to the fore. So it's not only about diversifying your economies in ways that make it more resilient across borders, but also how domestic systems complement that exposure and can help you deal with the risk. So the point is, if you bear in mind those, and if you agree that these are the key sources of vulnerabilities that you have, you may have, other ones. Matt would be interested in hearing from you if you think there are other cases that we are missing here. So, but if those three are essentially right in your mind, what can policy do to deal with those vulnerabilities in ways that could increase resilience? So, in this case, what we are arguing is that if it is true that we are in a more shock-prone world, a big part of the resilience story is about adaptability. How firms and how sectors in your economy can adjust to technologies, processes, products, the ways they basically, go about their business, beyond the use of capital and labor, which is more closely related to the points I was making before about how your markets are regulated and so on. But how do firms operate internally in their processes that could make them more adaptable to changing conditions, and then more resilience to the shocks that they may face from that point of view. I mean, one key aspect of adaptability is technological adoption of firms that tend to be more, technologically advanced, or tend to be more, adept in terms of the type of mix of technological standards that they use. They tend also to be more adaptable to shocks, to changing economic conditions. And that's an area where, if you look at this chart, you are doing less well than many OECD countries. Essentially, what you have here is that if you think of technologies for core business operations, adoption rates are relatively low in the case of New Zealand. So that limits not only productivity growth in normal times, but also the ability that your firms have to adapt to shocks when they eventually hit you. So what can policy do about this? Essentially, in terms of adaptability and in terms of choices that firms make, this is about firms' choices. It's not, there is a limited scope for policy intervention in this area. It's firms that need to decide where they want to sit in this trade-off between, for example, being more robust, so minimizing their exposures to risk, managing risks through their own internal mechanisms, and then improving their ability to resume operations if they are hit by a natural disaster and so on, but they have a negative shock that they can then adapt to that. So firms need to be in the driver's seat from this point of view. But policy can help make that process more seamless and prepare companies for that. And I'll try to get to this point a bit further now. But let me show you, if you think of adaptability, if you think of resilience at the micro level, what are your strengths and your weaknesses in this area, in the way we are thinking about this? You have fairly strong things going for you. You have a big share of renewables in your energy matrix. That's something that you stand out by comparison with other OECD countries. You have strong comparative advantages in sectors like, obviously, agriculture, forestry, a number of areas where New Zealand is recognized as a benchmark, and in those areas. And you have, obviously, your institutional quality that I mentioned at the beginning, that is a strong asset that you have in that respect. But in terms of weaknesses, fuel dependence, relatively thin ecosystems, distance and scale constraints that obviously tend to be important. Larger markets with larger domestic markets tend to have built-in mechanisms of risk sharing and risk pooling that smaller economies do not have. But let me show you a chart that is essentially about your capabilities in the area of diversifying your economy. If you look at the concentration of exports at the sectoral level, you see that they tend to be pretty high by comparison with other OECD countries. So your strength is in the area, for example, of advanced engineering, aerospace. That's another area that New Zealand is recognized as having important assets. Your ability to transition agriculture to lower emissions production technologies and so on. Your forestry moving towards higher value added biomaterial. So those are, very important elements that you need to think of, and that could help you have a more diversified sectoral export base that contributes that to risk mitigation. The problems that you have, or the difficulties that you have there, are well known as well. Scale, as I mentioned, skills, coordination, diffusion, some aspects that are also very important at the micro level. Let me spend some time here talking about the policy tools that you can use to build resilience through diversification. I think one or a number of areas that are the ones that you see here in this slide are the ones that are coming up more and more in discussions with countries. And I will elaborate a bit more on two of them. I think in the area of skills, what's needed to make a more adaptable economy, that's relatively well understood. If you're thinking about the demand side tools that can be used, many countries are using more, the definition of norms and technical standards of procurement mechanisms to kind of steer a bit more this effort towards greater resilience, competition policy that I mentioned before, how reallocation friendly your regulatory settings are, and so on. But the first 2 points there are ones that we've been hearing more and more countries think about, and that's what I would like to spend a little more time on, which is essentially the idea of extension services. How can you support actively diffusion of technologies among firms? How can you facilitate adoption of these technologies among firms and so on? And the other one is the issue about coordination platforms. I'll then turn to those two in a little more detail, and hopefully, you'll tell me if you think those are relevant in the case of New Zealand and what more can be done in this area. So let me turn first to the idea of extension services. What are extension services? Sometimes it's important to define those things since they are not exactly very mainstream names in the way we've been thinking, at least about micro resilience. These are essentially the idea of technical support. How can you provide services that can help firms implement better ways of working? So not only just adopting technologies that may be available, but also thinking about the ways they organize themselves and they can improve their managerial ways of doing things. Most firms know broadly what to do. I mean, we can see that from surveys of firms across OECD countries. Most of them, they know their stuff. They know what needs to be done. What is harder for them to do is basically to implement some of those plans. And what we are seeing is that in some countries, what governments try to do here is to facilitate that type of services that firms need to do those things better. And how can they do that? Sometimes accreditation of service providers in this area. There are countries that have a tradition of doing that. There are other ones that are less good at doing that. How to coordinate at the system level, at the sectoral level, those delivery organizations. Sometimes it's institutions, sometimes it's universities, sometimes it's private agencies that work very closely with firms and help them at the management level, at the level of implementation of risk management strategies and so on. In some cases, governments co-fund some of those services alongside firms, and they try to develop that ecosystem, if you want, of extension services providers. These are just examples of 3 countries that have interesting experiences in this area. We just highlighted Denmark, Germany, and the US as interesting institutions in that area. Here, it's not, I'm citing those 3, it's not about replicating institutions. Each country has their own traditions and constraints in this area, but basically, thinking about the functions that they perform in those countries and how governments can support that type of activity at the firm level. The other point is about coordination platforms. We've been hearing a lot about the potential of establishing those mechanisms as a way of then sharing information, allowing firms to basically understand better their own supply chains, understand better their own risk mitigation strategies, understand better shortages that they may be facing, not only in terms of basic inputs, but also labor and skills. It's about creating really mechanisms for firms to understand what they are facing better among themselves and learn from government in areas where information failures can basically be an obstacle to greater efficiency in this area. There are situations where, for example, if you think of adoption of new technologies, there are several cases where firms, even those who are willing to move, they basically take a wait and see attitude, especially in areas where technology is moving very fast. Risk of ending up with stranded assets if they move too fast ahead of competitors, if the market is not prepared to do that, if the government is not providing the type of framework conditions for that to happen. So, these coordination platforms can help in terms of identifying those blockages, and even for governments to have a sense of what the needs are at the firm level or sectoral level, then they can then act at the policy level to make sure that those obstacles are removed, or the conditions that firms see as important for adoption of new technologies, exploring new markets, and so on, to materialize. So, I mentioned the case of technological change as one. Electrification, for example. Now we see that the transport sector in many countries is a large emitter because of the fuels that those sectors use. And we are seeing that in many cases there is a coordination failure that prevents further electrification. Governments need to know what they need to do, what the shortages are in terms of charging stations. There's a story that is well known to all of us. And firms then, creating a mechanism where there is an understanding of the fragilities, the vulnerabilities, the needs for policy action can help that. It sounds a bit, saying this, it sounds on one level pretty obvious. And on another level, pretty surprising that sometimes more is not done to correct those information failures, to facilitate that exchange of information, to have a very fluid mechanism of dialogue with the private sector. And it's not only setting up talking shops, frankly. It's about really understanding what the needs might be and the room for policy action in some of those areas. There are countries that do that relatively well, and that can provide interesting examples of what can be done in that area. So, just to leave that with you, that, we see more and more that this can be a very powerful mechanism of increasing resilience, making firms more adaptable, more scalable, even in many cases, which is a particular challenge, I think, in the case of New Zealand. So, what can you do? The issue is there are some policy options here, and you need to prioritize. You cannot move in all directions at the same time. What we are suggesting in this case is that when you act on those fronts, one guiding principle could be, what are the interventions with the greatest impact at the system level, and at the same time, minimize costs and can deliver results that are, relatively front-loaded, so that you start preparing your economy very, very, soon in the crisis, if you want, cycle, and that obviously have relatively light capital needs. We like to think of it in terms of a tiered structure for thinking about, setting priorities. One is, obviously aiming for system-wide intervention, and that's an area where what I've just mentioned, extension services and competition policy, regulation, but also the coordination mechanisms come in, because those can be geared towards systemic issues more than other more targeted interventions. And then a second tier, that is, how can it catalyze change in other areas. Many countries are using pilots to do that. Picking sectors that are very strategic or where vulnerabilities are known, and then try to work more closely on the key actors in those sectors to refine those policies. And then a third tier, there is a bit more selective, where you know when you found out based on these interventions that there may be a missing market where funding may not be available, where there is a need for some financial incentive to be put in place. Then you can think of minority equity participation in some of those sectors, but always, again, to make sure that this is money well spent, that there is partnership with the private sector, that it's based on all the standard, conditions of effective cost-benefit analysis and so on. But in some cases, that missing market issue can be addressed with some participation of the government in those key areas. If you were to choose, what to do over the next, say, 2-3 years in the short to medium term, I think based on what we are seeing, based on the issues that we dealt with in the economic survey, I think there will be a lot of merit in the case of New Zealand to think about issues of, dealing with the fuel resilience, and you are thinking about that. We developed this argument in the survey as well, but it seems to be a very pressing challenge to be addressed. The issue of, again, related to energy, well, if you want to reduce your exposure or vulnerability to supply risk in fossil fuels, then, obviously, accelerating electrification is something that countries are also thinking about, not only as a short-term vulnerability risk management strategy, but also to facilitate the energy transition, to facilitate the greening of our economies, and so on. So potentially a win-win combination of interventions there. Again, going back to the case of what can be done at the micro level, extension services, coordination platforms are interventions that can be you can think of, acting on that front in a relatively short period of time. What not to do in our mind, that's one thing that we are telling countries all the time, the temptation sometimes to be more interventionist in ways that can be very counterproductive in terms of, very broad subsidies, local content rules, protectionist support. So areas that are really about, dealing with the risk from the point of view of, cushioning some sectors in ways that can be very costly economically, that can lock in choices that will have, adverse effects in the future. I know this is not something that New Zealand has a tradition in doing. You like to have policies that are really a lot more market-based, a lot more conducive to having a more adaptable economy. So I would say, make sure that you don't go down that road, because it can undermine resilience in the long term rather than help. So let me move to this just to conclude, so that you don't get too tired of listening to me. I just wanted to stress these points about how we see New Zealand in this. The world is going through a huge shock now. We've had a series of shocks over the last few years that has brought to the fore issues that, in policy debates that we were not thinking, or that we didn't think about for a long time, related to resilience of supply chains, related to how you manage an increased frequency and an increased severity of many of the shocks that we are now having to deal with. But essentially, you have an economy that performs well in good times. You have macro institutions that are very robust and that are very much, by our experience, associated with good outcomes in this area. What is important is to make sure that you become more adaptable in bad times. So not only to have an economy and a way of thinking about policies that prioritizes efficiency in good times, but also having to deal with resilience and adaptability when you are under stress. Again, as I mentioned before, this is not a policy mistake. No, it's not that you should think about, what have I done wrong in the past? We don't see it like that. I see the fact that you focused on efficiency and performance in good times at a period that the world was going through a relatively tranquil period as something that was the right, policy choices to make. The issue now is that the world has changed. The nature of shocks is changing. So how you make sure that you preserve one, which is the efficiency, the way you operate in good times, and how you prepare for the case where the world has become much more, the policy environment has become much more uncertain. The world has been, and the economies of the world as a whole has become more prone to shocks. So basically, just a few thoughts of how we are seeing this, how we are discussing this issue with other countries, and very happy to hear from you about any thoughts that you may have on that, especially on what we may be missing in terms of how you are not only thinking about the issue but also preparing yourselves for that. And great pleasure to be here. Thank you very much.
Thank you. That's working okay? Yep, all good. Oh, thank you very much for what's really a fascinating presentation, Luiz. I just in terms of an observation rather than a remark, I think we've been really fortunate at the Treasury to have a number of guest lectures over the last couple of weeks that have approached this issue of resilience from slightly different perspectives. So we had Alan Bollard a couple of weeks ago, who was very much talking about it in the context of New Zealand's position in the world and how New Zealand positions itself in the world. We had Professor Prasanna Gai earlier this week talk about it much more from a macro perspective, and in particular, how do you think about monetary policy in the context of the way in which the world is changing and also the current shock. And so I think it's just, it's really great to have the perspective, more of a micro-resilience perspective moving forward as well, because as you say, it's an issue that we are increasingly needing to grapple with and change our way of thinking about it. It's been a really rich set of lectures over the last couple of weeks. So I really encourage you, if you haven't been able to attend, they're all online, so please look at them online. We have plenty of time for questions now, and we will take them online, so please keep them coming in. I think we have a few there. I'll open up my computer in a minute, but we'll also take questions from the room. If you can just please introduce yourself before you ask a question and where you're from, that would be great. And just a reminder that Luiz has also invited us to provide our perspectives on what New Zealand needs to focus on. And certainly as a Treasury, we'd be really interested in hearing those as well too. So I will open up to the room in the first instance. We have a microphone at the back that will come round as well. Who would like to go first? Right, Rory, thank you.
Might not even need a microphone. Online, do it.
Yes, you do, just for the online. Thank you.
Good, Luiz. Good, thanks. Jeff Simmons from Parliamentary Commissioner for the Environment. Thanks for the presentation. Fantastic, as always. As advisors in a world where resilience has greater value over efficiency, a lot of our tools for thinking are based around efficiency. Do you have any advice for advisors for what sort of tools we should be using to help think about the value of resilience over efficiency, if there's a trade-off between them?
It's a very good point. I wonder if we needed to persuade the political masters of the importance of thinking about resilience in a world that is visibly more volatile. So I think that is, I wonder how much of how persuasive we need to be to make the case that we need to think about resilience. In terms of the trade-off between resilience and efficiency, recognizing, I think, the economic costs of some of the interventions, I think that's the way to think about it. For example, what I described at the end of what not to do. sometimes the temptation to use some of those things because they tend to have an immediate payoff. So the trade-off that I would see there is that it's the long-term, short-term tension that some of those interventions represent. Issues related, for example, to building redundancies in systems, that has an economic cost. Having to build more strategic reserves, so that has an economic cost. Issues about building resilience in electricity systems, for example, that many countries are realizing that it's important to do that, so that you have bigger margins and more scope for action when you are under pressure. That has an economic cost. So I would say that recognizing those upfront. So in terms of tools, how do we measure that in ways that can be solid enough, and the case can be made for investing in that, not seeing that as a cost, but as an investment in a situation where the nature of shocks may be changing, that we need to build, to guard against some of the issues that we over the last few decades didn't have to think about.
I'll go for one online now. So this one is: industry policy is back in vogue across OECD countries, increasingly with the resilience policy justification. And you recommend supporting diversification of what is a relatively concentrated export market. Do you see horizontal levers as sufficient for increasing diversification and therefore resilience, or is more direct intervention with vertical levers also necessary?
It's an open debate. How much you want to invest in vertical interventions as opposed to horizontal interventions. I think there is still a lot of room at the horizontal level for action. I think some of the issues that I went through now, show that before you go to more vertically focused policies. Precisely because of the costs. To go back to the point about those tensions and trade-offs. Some of the vertical policies may turn out to be much costlier than originally expected, especially when they're designing them. So exploring and exploiting all the room that you have for horizontal interventions, I think there is a huge payoff to that. And some of the cases there, again, that we are seeing in our dialogue with countries, those are pretty much, horizontal interventions that have known payoffs. Some of them are about even discovering margin for intervention that we didn't assess or we didn't see before in ways that can be very useful.
Thank you. And I think, the other interesting point for me is some of the things we're trying to resolve are systemic issues. So in terms of what are the horizontal platforms out there to address some of those more systemic issues? And as you point out, a coordination failure or a lack of information is often a systemic failure as well. So I think that's really important. In the room now, who would like to take the next question?
Hi, thank you very much for the presentation. Benjamin Stubbing from the Treasury. The classical liberal perspective is usually not that shocks never happen, but that firms and households possessing local knowledge and facing prices, they're best placed to make decisions. So I wonder then, what now is the missing market failure? Or in other words, I've asked the two other speakers, what is different now to make Hayek less than sufficient?
What is different now is, I think there are many things that are different in the sense of, one is this assessment of the risks that we are exposed to. Have they changed in nature? Have they become more frequent? Have they become more severe? I mean, that's one element that needs consideration. The other one is obviously, how prepared we are based on what we have at the moment to deal with them. So that is different from what we had in the past. Some consideration now, even related to the fuels prices that we are going through, is how much can we rely on price mechanisms to clear markets when you are confronted with possibilities of delivery shortages and risks. So, that also calls for, different ways of thinking about problems that would change the relative costs of interventions as well. So countries that are investing now, for example, building strategic reserves, recognizing the cost of that, but also knowing that, well, there is an upfront capital investment, a sunk investment that needs to be dealt with. But faced with the risk of rupture in delivery, that cost may be much lower than the alternative of not having that type of investment. So I would say that those are just, a couple of 3 examples of areas where need to be at least, if not more responsive to that changing nature of risk, but at least, understanding them better in the way you call the character, which is the systemic aspects of those risks.
We've got another interesting question online, which I think kind of gets to the point of, well, what's the role of government versus what's the role of firms themselves in terms of building micro resilience? And it's, why might government be better placed than the market to provide extension services and coordination platforms?
I think that's, again, just to recap the key point here, the firms need to be the drivers, right? It's the private sector that knows better, their business. The point for government action is where are the failures? Is there an information that is not there, that is not flowing because there is something missing there? Is there a coordination aspect of it that needs to be thought of? That's the role where, that's the area where public policies make sense. It's not telling firms what to do in their own areas and what technologies to adopt or, what the markets to operate in. No, it's essentially, what may reduce obstacles to effective decision making at the firm level. And we see there is plenty of that in terms of information, in terms of coordination, in terms of even how you position yourself, given the way technologies are changing in the world nowadays. So, making sure that the governments act in those spaces, I think that's what needs to be highlighted in this area.
Is there a question in the room we can go to now? Yes, James.
Thank you. James Barnett, currently in our Middle East response unit here at the Treasury. So my question is related. You talked about building fuel resilience. My question is how? So, yes, on one hand, we could spend a lot of money to build government strategic reserves, but we don't have a refinery, so there's practical implications of storing refined fuel. It expires. Then, and carries massive costs. We've already increased our minimum service obligations a few years ago, and there's another one coming through in 2028 for diesel. So what more can we actually do to increase our fuel resilience? Like, yes, there's a medium to long-term question about electrification of the economy, and that seems quite a sensible approach. But in the more short term, that 3 to 5 year horizon, what can a country like New Zealand actually do? Is it signing more deals like the one we just did with Singapore, for example?
I think that is a very powerful instrument way of dealing with that. If you can make sure that you have agreements with countries like you have with Singapore now that reduces delivery risk, I think that's a very important intervention that can be that makes sense in the short term already. You mentioned the longer term aspects. Investing signaling now, making sure that the options that you go for do not blunt signals that are important for the economy to adjust over the longer periods of time. That's also a very important policy action in this area. The issue of strategic reserves. If you revisit what you have and you deem that insufficient for the type of shocks that you are facing, and yes, investing more in that. You'll see in our economic outlook, we are putting together the economic outlook of the OECD, the spring edition that will come out in June. We see that we we started looking across countries at strategic reserves, what countries have, for how long, what type of fuels, what type of inputs. And you see that there is a huge variation across countries. You have countries here in your part of the world, Japan, that is top of the chart in the OECD in terms of strategic reserves for fuels, for other critical inputs. And that is not something that they came up with in the recent past. It's a country that has a tradition of dealing with natural disasters, a country that has a tradition of essentially thinking about what needs to be available in a situation of extreme stress. I think Japan, offers some interesting, lessons in this case. We're not saying that countries need to have that type of emphasis in their defense mechanisms. It depends on the nature of your economy, what it needs. But discussions about the level of strategic reserves is very important. That's something that is, needs to be thought about in the short term because, they require investment. Investment takes time. It takes time, especially in a world where everybody else will be thinking about the same. So there will be competition. How you invest in those technologies. Strategic reserves is not like, building warehouses where you can. No, there are very sophisticated ways of doing that, and technical constraints to doing that. So it's time to think about it, and to make decisions about what levels of what that you need to think about.
Thank you. I think there's also a link there with some of your other recommendations, which to some extent building fuel resilience also requires us to reduce our fuel in some areas too, and think about that structural adjustment process. So I think there's a link there. I might just take one more from the room because I think you had your hand up, Ken, didn't you? So we'll just take a question from Ken and then we'll move back online.
Thanks very much, Ken Warren. I want to pick up the question that was asked before about governments providing the extension coordination services. Seems to me that in a country where we've got a very large number of small operations, that it's quite difficult for the government to reach those. And it seems to me there'd be a good role to play for industry associations and pubs, and the role of government to encourage them to provide those extension and coordination services, so there's a sharing of risks amongst a lot of small entities would be possibly a better way for us to go. And I'm wondering whether there are international examples where they've kind of taken that route.
No, listen, absolutely. I didn't mean to give the impression that governments should do that themselves. It's not for the government to basically provide those services itself. In the cases that I mentioned of those, Denmark, US, Germany, that it's precisely through the mechanism that you described. It's associations, it's representatives, sectors. The role of government is, if there is in the case of extension services, there's a need to accredit, for accreditation of the providers. That's an area where the government step in. It's not to do it itself. It's essentially to make sure that there is enough supply of those services. Sometimes also a role for policy is to raise awareness through different mechanisms of the relevance of those services. Sometimes firms don't know. So even that, going back to the information failure story, that's a scope for action, and governments can do that in the ways you described. Totally agree with you on that.
I'll go back online again now, which is a question that I actually would really love to hear your answer to, Luiz, which is, where does productivity sit in the context of the resilience gap? Specifically, how can lifting productivity enhance economic resilience to external shocks in small?
That's a great question. It's one that is very complex. Listen, let me take the flip side of that. What is the impact on productivity if you become more volatile, if you become more exposed to shocks? That obviously has a negative impact on productivity. Via what? A more volatile environment is one where there is less investment, where there is less willingness to take risk, where there is less, investment in building skills and investing in human capital accumulation and all that. So if you to take the basic, what we know from economic theory, the literature, what drives investment, uncertainty is probably the most powerful negative driver of investment. So I would say that not the cost of inaction in this phase is huge from the point of view of impacts on productivity. So if you move from the opposite side of all that, so the cost of the merit of action, all these areas that we've been talking about for productivity can be pretty sizable. And it is important not only carrying from a point of view of a small open economy, but from the point of view of an economy where productivity growth has declined over time, where you are growing not on the basis of productivity enhancement, but on the basis of using inputs. I mean, you've been lucky to have managed to raise labor supply through participation, employment. Immigration has been a big boost, to labor supply in New Zealand. But that may not go on forever. That ability to use inputs may not go on forever. So working more on the productivity front is important. You're not alone, in that respect. We've seen that on average for the OECD, productivity growth has been coming down. So it's a message that also we are trying to get across for a variety of countries.
There's a lot of questions online, so thank you very much online. There's a couple here that are around alternative fuels and the ways of encouraging uptake to an extent. So I'll probably try and just combine a couple of them. The first is around what income tax concessions introduced by other countries might be appropriate for the New Zealand situation, and that's both in terms of supporting electrification and solar. And then there's a similar question, which is around would government subsidisation of solar installations for domestic and fair use reduce the need for maintaining costly infrastructure and decentralisation of quickly. So I think it's just a broad question in terms of when we start thinking about some of those alternative sources of energy, and we do see a lot of other countries explicitly supporting development of those sectors. How would you think about that in a New Zealand context?
Listen, in the New Zealand context, you have huge comparative advantages already. Sectors that are, you already, David will correct me when the number is wrong, but 80% of the electricity here is generation comes from renewables already. We have huge potential in geothermal. We have huge potential in solar and wind. Biomass. Biomass is big here. It's a huge comparative advantage that you have. So you don't need to act more. You already have those sectors operating. Generating this type of energy mix that you have in some areas, and then the experience of OECD countries. I think the case of electrification of transport that I alluded to. There are several countries that subsidize electric vehicles. Make sure that the cost differential, they will create a cost differential that will encourage people to buy EVs. What we are seeing in most countries now is that they are shifting away from that because the technology has changed. The cost differential is already much lower. EVs are becoming cheaper relative to internal combustion cars. But governments are acting more on the systemic, part of it. There is a network of charging stations, dense enough that people would be able to shift. So just one example here, Karen, just to make sure that there are areas where you can think of the merits of intervention depending on conditions, but in other areas where people have comparative advantages in.
Go back to the room now. Jeremy, I think you may have had a question before, so I'll turn to you.
Thank you. Yes. Jeremy Kinley, I'm in the Economic and External Strategy team at the Treasury. Sort of touching more on some of the, productivity resilience points that have come up. I'm interested in how you see productivity and resilience conversations being integrated together. Do you sort of see productivity as something that, which you increase, can improve resilience, or do you see sort of targeting resilience with policy as being a key step to boost productivity, or sort of a combination of the both?
Yeah, listen, I don't think I would risk picking a direction of causality there. I think she tend to be to work both ways. If you raise productivity through policies that are pro growth, pro efficiency, and that deliver resilience at the same time, you're going to have a productivity payoff at the same time. Typically, economies that have higher rates of productivity growth are the ones that tend to be also more resilient because productivity is coming not out of the blue, but because of the way those economies operate. So,
In the room. Yes, sorry, I'll cut you after.
Kia ora, my name is Helen Murdoch. I'm from the Public Service Commission. I was interested to see the countries you provided as the example for the extension services and coordination, where all of them have quite a lot higher levels of R&D investment relative to GDP compared to New Zealand, and interested in how you think about the relationship between the level of funding and the structures that are there to kind of use that funding.
okay, so what do those? I would also say that the examples that we mentioned are countries that have, at least in the case of Germany, a much bigger manufacturing base. So sometimes a lot of those services or a lot of that dialogue historically came from the manufacturing side of economies, no more than the service side of economy. I would say that, I haven't thought much about the type of correlations there. But I don't think there is anything in the functions that those institutions perform that would be hard to or would not be applicable to the case of New Zealand, given the economic structure that you have. So it's less the institutions and their history and more the functions that they perform that you can try to make sure that you find your own ways of performing.
I will come back to you, Sawyer, but just one question that's probably an add-on to that online, which is around the expense associated with coordination platforms, that there is an opportunity cost of investing in them, in both businesses and governments have limited capacity to engage. So how do other countries identify which topics warrant coordination platforms and ensure the benefits outweigh the costs?
Yeah, no, great question. From the point of view, where what you prioritize in a way, it's based on I think they're depending on how well prepared you are. So how far you are from having a systemic view of your economy sector. If you're closer to having that type of assessment, then obviously the economic equation changes. Now you're going to be. So I mean, where more investment needs to be made, more upstream, in understanding the economy and identifying systemic issues, the more you need to invest in. But frankly, I think it's money very well spent.
So you're fitting Treasury in the same team, external economic and external strategy. I guess the beginning of your presentation made me think of, what role does fiscal policy play in economic resilience? And, when I think back to New Zealand in 2022, 2023, automatic stabilizers kicked in, increased deficits, but at the same time, the government sort of reduced baseline spending, fiscal consolidation, et cetera. And so I guess my question is, to what extent should governments allow automatic stabilizers to sort of freely operate during a sort of shock or a downturn versus, actively maybe offsetting them to meet certain inflation targets? And what is sort of the trade-off with demand?
No, listen, this is a good question. It has to do with the macro mix of the time that a shock hits. I mean, the point I was trying to make there is that, not being constrained, at least, from the point of view of having sustainable public finances, having, the needed buffers in the short term, having low debt, that buys you space. So, in situations like that, letting the automatic stabilizers operate is already built-in mechanism that you have at the macro level to deal with shocks. But that depends on how you can afford that, and how your monetary and fiscal policies interact to create the conditions for that. We see in many countries that that's not necessarily a given. And the other aspect is, what is the size of the automatic stabilizers that you have? So if you are in an economy with limited automatic stabilizers, the ability of fiscal policy to stabilize the economy will be very different from a situation where you have, very potent stabilizers to begin with. So I would say that it's a matter of calibration of your policy response, but creating the conditions for having, the macro space for that type of stabilization mechanism.
There's a couple of questions online, which I think are both getting to a point around a broader risk space in the New Zealand economy that we might need to be preparing for or planning for. So beyond thinking about it in a geopolitical context or even in a climate change context, and in particular in respect of the labour market and migration. So I just wonder if you could provide a few words on what some of the other risks we should be watching out for looking ahead as well.
Okay, listen, Alex, let me take the opportunity. It's not a risk because it's known, but population aging, I think it's one that countries need to prepare for. So it's often something that comes up in the context of risk discussions, but again, it's not a risk because it's one of the easiest things to project, in terms of economic impact and so on. And there is a number that is interesting that we presented there in the survey. That is, in the case of New Zealand, how much that will cost you over time. And by our calculations, if you think of between now and 2060, all the aging-related spending pressures that we'll face, so long-term care, healthcare, pensions, that adds up to about 5 percentage points of potential GDP. So that needs to be dealt with at some point. So again, you are not alone, because many countries in the OECD are facing the challenge of very rapid population aging. So I would say in the case of New Zealand, how you address those issues ties in with how much fiscal space you're going to have over time, ties in with one big asset that you have, that is low debt, stable public finances, a fantastic first line of defense when you're faced with macro shocks. So, that interaction, I think, Karen, of, how you think of long-term pressures that are relatively well known, that interact with risks that you may know the distribution of, and interacts with uncertainty, areas where you don't even know the distribution of those risks. So how those things interact, that's extremely important. If you think of preparedness, if you think of resilience. If you don't know many of those things, what do? I mean, you think of building buffers, building space over time. You deal with what you need to deal with, that you know well, population changing. You deal with certain things that will also impose costs, climate change, and how that will impact our economies. You invest in things that will, have a payoff in this area, how you prepare your economy for the digital uptake, and how you, and then you build buffers for what you don't know, for the uncertainty, especially the uncertainty part of it, which is very difficult to deal with. But if you have space, you're a better place to face it in the first place, however shape and form it takes, but you'll have more latitude than if you know.
Yeah, I think that was an excellent place to end. I think it gets back to a little bit the conversation we were having ahead of the lecture too, is like, how do you make policy when what you're facing is uncertainty, risk, and I think that is a really interesting challenge for speakers going forward as well too. So we have run out of time now. So I just want to say thank you again, Luiz, for sharing your insights with you. That was a really rich and rewarding discussion. So thank you very much. And thank you to everybody for joining us either online or in the room for the Treasury Guest Lecture Series. Our next seminar is in fact next week. We just have a flurry of guests at the moment. And that is on Wednesday the 13th, where we will hear from Phil O'Reilly, who is Managing Director at Iron Duke Partners and former CEO of Business New Zealand, who's talking about a new world of opportunity if only we could grasp it. So registrations for that one are open via our websites or through Eventbrite as well. So, but just to close this event, I'll just say our Treasury karakia, piki te kaha, piki te ora, piki te wairoa, huie, sae, yay. Thank you everyone, and we very much look forward to seeing you next time. Thank you.